Hello, everyone, again. It is Pi Day. I was told my daughter's class reminded us that it's March the 14th, so it's Pi Day. I know Mr. Melnick is happy that I did not cover up any of the announcements from the Federal Reserve or any of those things. So I'm going to mute everybody here just to make sure the background noise stays down. But everybody does have the ability to unmute themselves if you'd like. Okay, so we'll have time for questions at the end, but we will be going through just a kind of a loose agenda here and sharing a couple of slides along the way. The um, uh, there's been a lot of questions that have been coming into our office, and as many of you know, the agenda for these sessions is largely generated by the conversations that we are having kind of in our day-to-day world. So hopefully this covers some of the broad strokes of what you're thinking. And if not, please feel free to jump in and add to it. There is a chat feature in going today. If you use that chat feature, it will come directly to me. So if you prefer to ask questions that way, feel free to write them in and we will do our best to answer every one of them. We will answer every one of them. We will do our best to do it during the session. Worst case scenario, we will cover it after the session with you. Okay? So just to jump right in, anybody who's watched the market lately probably noticed that the market has continued to do well. We had a very nice run towards the end of calendar year 2023. This year has been still solid, but a little bit more muted so far. And I think there's a lot of reasons for that. But in general, we've had really good overall market movement. But one of the themes that has been discussed a lot lately, and one of the themes that has generated a lot of questions, has been the concentration of some of the returns that we are getting. And you might have heard some wonderful terms in the last few weeks and months, like the Magnificent Seven, referring to the group of very, very large companies, primarily technology companies, that have been really leading the performance and that have become a much higher percentage of things like the S&P 500 and has really been driving the returns in there largely. And that's a good thing, I think, in general, but it also causes some questions. When you have that much power concentrated in a relatively small area, it also brings in the possibility that if things were to get a little bit ugly, just in a relatively small number of those companies, that could really hurt the market. So we wanted to talk about that first, and to do that, I'm gonna turn it over here in just a second to our friends at Skyview, Mr. Melnick and Mr. Turi, and just to kind of talk about that in general. But just to kind of set that, Steve and Andy, for you guys, we also have kind of a unique thing going on in the markets where, and this is really different than it was in some of, there have been other times where we've had concentrated returns and concentrated market presence, with larger companies. It happened in the late 90s. It happened in the early 70s. We have instances going back 100 years where there have been times that this has happened. But one thing that has definitely increased over the last 10, 15 plus years is the amount of investing that is indexed. Okay, the S&P 500 index funds that are out there in every retirement plan in the entire country, and the prominence of those investments just in people's portfolios in general. And what that creates is also a bit of forced buying, right? Every time money comes in from someone's 401k account, a contribution is made. If they have money that is indexed, especially in things like the S&P 500, by far the most commonly used index in investing, it essentially is forced buying into some of these, well, into all of those companies, but to in a proportional amount to those big, top performers that have been happening, or the ones that have been causing that extra performance over the last few weeks and months. So that is kind of offsetting some of this, maybe a bit of this concern, because don't ever forget this, okay? Anytime that you are talking about market movements, and when people are saying, well, why did something go up or why did something go down? Oh, well, you hear these reports every day. Oh, well, the Federal Reserve did this, or the earnings on this did that. So it caused markets to go up or down. Don't ever forget that there's really only one answer to any question about why did something go up or why did something go down. Something goes up when there are more buyers than there are sellers, when there is more buying pressure for a stock, an asset, whatever it might be. That price will continue to go up until enough people on the other side, on the sell side, say, okay, I'll accept that price, and those transactions are completed. Just like when things are going down. Why did things go down? Well, again, the only answer that is ever completely correct is because there's more people that want to sell an asset at any given moment than there are people who want to buy it, right? So the price will keep going down, down. I want to sell, down, 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 until enough people on the other side, in this case, the buy side, accept that price and that equilibrium is met, okay? So when we talk about the indexing and this forced buying just through normal contributions and normal activity, some of that has driven these positions higher. So anyway, with all of that, it's not really a question, Andy or Steve, but if you wouldn't mind kind of taking it from there, and talking about some of the bigger names out there, particularly the ones that are generating a lot of headlines, like Nvidia and Microsoft and a few of the other ones, and talk about whether that is a concern or perhaps some other reasons why that is slightly less of a concern right now.
Sure. Well, thank you, Mike, and good afternoon, everybody. Thank you for joining the call and having us be part of it as well. Andy, if it's okay, you want me to start off briefly and then, okay, you're on mute, but I'm assuming you said yes. Mike, can I just share my screen with one slide real quickly? Or it's not possible to share, that's okay.
You can. Nope, go right ahead.
Oh, okay. So I don't know if I'm going to start at a very high level. And what this chart is showing is the size of the global stock markets. And you can see the US is by far the largest around the world. In fact, it's more than all the others combined at $52 trillion market value. But of that, 13 trillion approximately are the Magnificent Seven that Mike was talking about. In fact, the Magnificent Seven by themselves is larger than any other stock market in the world. And so that kind of goes to, what Mike was pointing out, that, is there something wrong with these Magnificent Seven, or is there something that these Magnificent Seven are doing that is so dynamic and fundamentally different, or changing the way they can generate earnings and improving that growth of those earnings over time, that they're worth what their valuation is? And that's always a question. If you think about it, 5 years ago, a lot of people knew of Nvidia, but probably a small fraction of those that know of Nvidia today. And if really the only stocks that are larger today that are are really Microsoft and Apple. Now, Apple maybe has issues; they're not growing. But if you go back 20 years ago, the largest companies were by and large different, other than Microsoft and maybe Apple. So there's always a transition going on because the dynamic nature of the U.S. economy. and the way these companies grow and add value and generate earnings. And so I just wanted to show this at a high level, and that's something kind of unique about our markets. There are other markets that can do, other companies, obviously, in the Netherlands and other countries that are generating really attractive opportunities. But in general, those Magnificent Seven are, we would say, if you look at them each individually versus as a group, they might not be as expensive or overvalued as people, just in the media may think. Some might be, others might not be. And we think this environment today is very different from what happened in 1999 or 2000 with the last tech bubble bursting. At that time, those companies weren't generating, many of them weren't even generating profits, and they had these very high valuations. Today, these are some of the most productive companies with the highest margins ever in history that are growing at rates that no other company close to that size have been able to grow at in the past. And with that, why don't I hand it off to Andy?
Oh, Andy, you're still muted.
Silence is golden, Michael. Yeah, Steve's point is well taken. I think a lot of people are saying, is this like the bubble of 1999, 2000? And as Steve pointed out, it's not comparable. Companies back then, if you remember, it was the internet age, et cetera, and people were valuing companies on sales to number of clicks per minute or so on and so forth. Most of them had not been in business much more than 3 years at most, had little modest revenues, no profits, and questionable cash flow. And it was a bubble, and it proved it. And many of the companies did not last more than a few years. And as Steve pointed out, these companies are major companies with earnings, long track records, and very positive outlooks. I'm not saying they're going to grow as fast as they've grown, but they'll be around, and they're in a unique position because in many cases they have very strong franchises that will survive. Whether or not the stock stays high as they currently are is a question mark, but they're not going to disappear. The stocks may come down modestly, but at the same time, because of their outlook, they'll recover. And the other aspect of it is that other stocks are trying to move up, are moving up. And so we're seeing a broadening of the marketplace. Part of that is reflecting the economy. The economy is in pretty good shape, relatively so. And two, we seem to be going through if we can call it a cyclical recovery, but a recovery out of the pandemic. And so this is broadening the nature of the market, and it's also broadening it into smaller companies. That's it, Mike.
Okay, thank you. Yeah, I want to share something with you as well. And I can cover this too, or Andy or Steve, if you'd like to jump in. But this is just to illustrate this point a little bit, the point that Andy primarily just made. This is an interesting chart when it comes to the most commonly used metric about valuation, the PE ratio, right? Many of you may have heard that PE ratio. What that's, just for those of you who are maybe less familiar with it, PE ratio is P is price, E is earnings, right? So in its simplest terms, if a stock is at $10 and it has $1 of earnings, that would be a PE of 10 divided by 1, right? So there's a lot of different ways that ratio can be affected. But to Andy's point, this back in the late 90s, this is the top 10 stocks, the 10 largest stocks in the S&P 500 during all of these market times. And this chart, this lighter blue chart, shows that at that time, the top 10 stocks had an average PE or combined PE of more than 43. Okay. Now it's come all the way down, but during this time when these top 10 companies are basically 1/3 of the S&P 500 by size, the ratio for them right now is about 25 times, which is historically speaking, not really that far out of line. And it's not even as high as it was just a couple years ago when you can see this chart, see this jump up here. That was basically in the beginning of the COVID recovery after everything dropped and then the prices and everything took off because everybody looked around and said, wait a minute, we don't know if the world's going to keep spinning in the same way, but all of these tech companies that we're all using now, why are they down 30%, right? There was no reason for Amazon to be down 30% when we knew that all of this traffic was going to keep flowing to them. The prices jumped back up, but the earnings weren't there quite yet to support it, right? But these companies these are real companies. These are companies that are producing a ton of cash, that are extraordinarily healthy. As Steve said, they can't keep growing. The Nvidias of the world cannot keep growing at the pace that they are. I think, Steve, you said earlier this week, if I remember, if I wrote it down correctly, that they had 750% earnings growth last quarter, year over year. Okay.
Yeah.
Now that is essentially unheard of for a company that size. That's a number that is usually created by little tiny companies that are just getting going and are just have small amounts of sales and earnings, and they are jumping at the beginning. For a big already established company to grow at that pace is somewhat unprecedented. And what it may very well be is earnings that are being pulled forward, right? These are sales that everybody wants their chips, right? And for those of you who don't know, NVIDIA makes computer chips, and they make really advanced computer chips that are primarily used in artificial intelligence applications, okay? That's what everybody wants. And they are clamoring for all of these things because they're trying to build these models that are bigger and bigger and that are using tens of thousands of these chips to compute all of the data that is required to run these artificial intelligence models. Okay. But it has to slow down. It cannot keep going at that exact same pace, right? So we worry about that only to a degree, but it doesn't mean that it's going to go away. Okay. So anyway, that's just a little bit of a deeper dive into that concept, and to talk about, while a lot is being said, a lot is being written right now, as to the power and the potential danger, if you will, of having all of this concentrated in relatively small areas. These are areas that are not going away. Microsoft and all of these companies. Microsoft is the biggest company in the world by market cap right now at more than $3.1 trillion. And they were the largest company in the world in the year 2000. Okay, it's very rare for a company to stay up in that range for that long. And I have a bit of something. I have something real quick. It's kind of a fun thing. We've never done this before. Nobody at StraightLine even knows I was going to do this, but I have something new for today. I have a quiz. Okay. StraightLine employees and Skyview employees are not eligible for the prize, but there is a prize. Okay. So that chart that I just showed you, there was a spike in valuation back in the late 90s. The last time there was a spike like that in valuation was in the early 70s, 1973 to be precise. Okay. I know, Mr. Melnick, that was a time that
I was alive and well.
You were working on Wall Street. I know you were. That's why you're not eligible.
That's not fair.
All right. In the chat, okay, what was the largest company by market cap in 1973? First person to send it in wins. First person not from StraightLine or Skyview. Okay, and yes, there is a prize. So I'll keep an eye on that while we continue to talk. But I will tell you the other interesting thing about the top 5 companies that were in terms of market cap in 1973, 2 of them don't exist anymore. rather spectacularly. And I'll give you a hint on those. Don't guess. Well, this was one of the top 5, but Eastman Kodak was one of the top 5, and Sears Roebuck was one of the top 5, just to show you how markets can evolve. They gone. So, okay, I will keep an eye out on the chat. Oh, wait. Okay, it's over. Leo, you win. The answer is IBM. Okay, there were 2 that came in really quickly. Yes, but Leo beat you to it. So you win. And in 1973, IBM was the largest company in the country with a market cap of $47 billion. Okay. Microsoft is currently the leader with 3.15 trillion with a T dollars. So, okay, congratulations, Leo, you win. So, and it was a wonderful answer. Well done. All right, so there are a lot of other things going on in the market right now. I know that there are questions. We're getting questions about debt. We could, and the rate at which debt is being created right now, it is still a concern for us. It's something that we are watching very closely. It is something that the longer it goes in this way, the more of an issue it will become. It is a political event. Some of you may have heard that we have an election coming up at the end of this year. We know that this is going to be a big issue. I'm going to talk about the elections in just a second. I don't care if you are ultra right-wing Republican, ultra left-wing conservative. Most of the things being discussed right now in very opposite ways are things that they might say are going to improve the debt situation. Unfortunately, our view is without some rather large structural shifts in thinking, that is not set to improve markedly in the very, very near future. And it's something that we have to keep an eye on. There are market implications for it, and there are real life implications for it. So anyway, this is something that for those of you who are working with us, particularly with assets outside of an employer plan, you have noticed that we've made a number of shifts on the bond side, the fixed income side, the relatively more conservative side. And that is in part related to where we believe things are going, primarily in the short to medium term. And to speak of that for just a second, this is the first time in probably, I don't know, at least 6 or 7 quarters that the first thing we've talked about has not been interest rates or the Federal Reserve's reaction to interest rates. This is still kind of simmering beneath the surface here. This is still a significant issue. Just today, there was another inflation report that came out that was a little bit elevated. Might be a reason why the markets are down just a little bit today. Probably is the main reason why markets are down a little bit today. And it's not that it's not inflation itself. I don't think that that's a huge shock to anyone. You know, inflation is not linear, but the fact that it was a little bit elevated today means that the Federal Reserve is less likely to start cutting rates, and if they do, they're not likely to be as aggressive about cutting those rates. Okay, and that's not necessarily a good or a bad thing. But in economics, you can't pull one lever without affecting many others, and everyone here has heard me say that. So we're following this, but markets and traders with a D, not traders with a T, traders like declining interest rates. It tends to be good for many investments, especially on the growth side. So a lot of the market for months had been moving primarily based on expectations of where interest rates were going to move. Okay, and at the end of the third quarter last year, the Fed started signaling that they were going to start cutting rates, and the market immediately said, okay, here it comes. They're going to drop that all back down. They're going to cut 6, 7 times in 2024. We never really felt that that was likely, or certainly not necessary. And to put it another way, I don't think any of us really want to see the economic conditions that would make that kind of a response necessary, right? That tends to happen when markets, or when the economy is not doing well, right? So inflation kind of staying somewhat elevated probably leads to interest rates for now staying roughly the same. We still believe that it is far more likely that the next move in rates is down rather than up. It's not impossible for it to go the other way, but we believe that it is still, as of now, more likely for that trend to decline rather than increase. But where we are with interest rates, don't forget, it feels weird because we haven't been here for 15 years. But historically speaking, where we are right now is pretty average. And as many people on this call know, you look back in the late 70s, early 80s, if you were buying a house at that point, interest rates were in the teens comfortably, and many interest rates were well above that. So that trended down through the 80s, 90s, 2000s in general on a fairly predictable path, except for credit cards, of course. Those stayed there. But everything else started to trend down and really follow that pattern for close to 40 years. So where we are now is, we believe, at least for the foreseeable future, maybe that time is measured in months for now, but we believe that where we are is roughly where we're going to be, plus or minus a small amount. And I think the Fed has started to signal also that those cuts, or at least the expectations about the number, the frequency, and the impact of those cuts, the amount of those cuts, the market was probably a bit ahead of itself. Okay, so that's we were laughing about this a few days ago when we were preparing for this discussion, because we didn't talk about the Fed until the end of the call. So we brought it up, I guess, second here in terms of the major issues, but it is still significant, and will still be driving things. Okay, so the next piece, I mentioned elections. We don't want to get into elections in detail. This is never, as you know, this is never about politics per se, or about what anybody believes is right or wrong or good or bad. We look at it in terms of what is most likely to happen. Okay, as of now, we have 2 candidates. This is we don't need to get into any details. I know these candidates bring up rather strong opinions, but as it appears right now, and things could change, but we have our participants in our election in November. From an economic side, there's a lot of things that are going to be said. There are a lot of things that have come out in the political spectrum, budget proposals and other things that might potentially impact markets or accounts, or how these things work. It is way, way, way too early to know what is going to survive the negotiation process, what is actually going to be approved or not approved. So we don't need to get into that or worry about that too much. Impacts, grandiose things are going to be said right now about Social Security and all these other things. There's a long way to go to figure out who the winners are, what Congress looks like, and what is likely to actually get through. Our system of government is designed to be slow. It was built to be slow. And so when you hear, there's a big difference between campaign promises and approved policies. So we're not going to get into that too much. However, there is one area that is rather relevant and that you will be hearing about more over the next few months, and that is tax policy. The tax policy that was put through, income tax I'm talking about, the policy that was put through in 2017, which are for some people affectionately known as, for some people derisively known as, the Trump tax cuts, who got him, but he was the one who got him through during his the first part of his term. That set the income tax brackets that we are in right now, and it set the pathway for them all the way through 2025. Conveniently, right after a presidential election cycle. You will hear more and more as the year goes on. What are you going to do with the Trump tax cuts? Are they going to be extended? Are they going to be modified? Because the way that bill was written is that if nothing happens at the end of next year, 2025, tax rates would revert back to where they were in 2016. Okay, which historically speaking is not horrible, but it's not quite as advantageous as the rates are right now. So that is something that we are going to be watching very closely. Again, this is not just about what people are promising on the campaign trail. It's going to be about what is likely to happen given the makeup of government past November of this year, really past January, I should say, of next year, when the next Congress would be sworn in, and either President Biden is continuing or someone else is there to step into that role. So that's just something that we're watching. Again, we won't get into too many specifics of it yet, but through the next few quarters, we will talk about this more and more, certainly. Okay, so I'm just going to keep going here, if that's okay, Steve and Andy and Sonny. I seem to be on a roll, so I guess I'll keep going. But there is one other concept that we definitely wanted to talk about today. And this tends to happen when you hear investment themes repeated, or when a hot news item comes into everyday language, even for folks who maybe don't follow investments all that closely. And the one that has been popping up and where we have been getting a lot of calls lately is cryptocurrency again, primarily Bitcoin. So I want to talk about this again. Now, some of you might remember that there was, on the heels of the last time that crypto really was spiking up and was really a big big news item, that was about 2 years ago. Okay, particularly as a little, well, pushing 2.5 years ago. Some of you might remember the Super Bowl in 2022, which was completely dominated by commercials in the cryptocurrency industry. And some of you all might remember, if I may speak about myself for just a minute, that right after the Super Bowl in late February of 2022, I actually was quoted in an article about cryptocurrency that was picked up by some producers at NBC News, and I was asked to appear on the Today Show, and they were specifically asking for, I quote, a voice of reason about the mania that was happening at that time. So I was fortunate enough to appear on that, on the show at that time, and that clip is still on our website and on our YouTube channel. And if you haven't watched it, or if you haven't watched it in a while, I would encourage you to watch it again. Not to see me, I swear it's not for that reason, but to see some of the names that were on there and to think about what the world really looked like. Because pretty much all of the other people that were featured in that, and with the industry that they spoke about at that time, are either out of business or have been sued, except for me, thank God. But there was a lot of craziness that was happening in the exchanges at that time. And it was just a few months after most of the cryptocurrencies had hit their all-time high. Okay, well, here we are. So the all-time high in Bitcoin, and everything's following, all the major ones are following pretty much the same pattern. But the all-time high at that point had been set in November of 2021. Bitcoin at the time was around $68,800. It has just recently, just in the last week or two, hit those highs again. Okay, it's actually surpassed those highs. It was well, here, let me show you. This is a chart from 2 hours ago. And in the world of cryptocurrency, that's ancient. But this chart, I took this snapshot at, well, I guess 2.5 hours ago. I took this snapshot at 12:05 p.m. of the price. So Bitcoin was hovering at that moment just below 71,000. It actually hit 73 about 3 or 4 days ago. But this was the peak 2021, 2022. This was actually the peak, I'm sorry, November-ish of 2021. Now, this has been a big craze lately again. But in between those times, it wasn't real fun. There was, some people called it the crypto winter, because down here in, ironically, November of 2022, it went below 16,000. Okay. So what does this mean? Anytime there is an asset class that moves around this much, and particularly when it's on a trend like this, right, where it's gone from 16,000 to 70,000 in a relatively short period of time, it is something that naturally causes questions, and it's something where people want to invest. Okay. Now, is that bad? Is that good? The answer is no one knows. Okay. Cryptocurrency, my explanation of cryptocurrency, my answers to questions about crypto and Bitcoin have really not changed one bit in the last 3 or 4 years, despite all of those price swings. Okay. And my position with it, StraightLine's position with it, has been, this isn't necessarily good or bad. We simply don't know what this is or what it is going to be. We still don't. All crypto, Bitcoin to a slightly less degree, but most of it has very little utility in the world. You can't really, even though it has currency in its name, very little of it can actually be used for actual currency or as a replacement for currency. Bitcoin has by far the most utility in the world and in the economy, but it is still fairly limited. Okay. And it certainly, 4 or 5 months ago, Bitcoin was at 35 and now it's at 70. Well, its utility has not doubled in the past 3 or 4 months. And we still don't know how governments are going to react. We still don't know fully how the IRS is going to react. We don't know exactly who the winners are going to be in this space. Bitcoin is the biggest one right now. That doesn't automatically mean that it's going to be the winner. But we are also not saying that it's worthless. We are not saying that it is air. Well, technically it's all air, but that's a little bit different. We don't know yet what this is going to be. What does that mean? It means that it is still very speculative. Okay. And there's nothing wrong with speculation. Okay. There's room for speculation, but you have to know when you are speculating. Right? It is very, very important to know the difference between investing and speculating. So we always want to differentiate those things, and you always want to make sure that you are not speculating with investment dollars that are absolutely essential to your life, to your future needs. Because for every speculation that works big, okay, and some of these, we all know this, some of these have hit monstrous numbers and have followed unbelievable paths. Bitcoin at one time was worth a couple of dollars. It was worth pennies when it first started back in 2010. So yeah, had you grabbed it at that time, had I grabbed it at that time, yes, we would be trillionaires, right? If we could rewind time. Great. I am not a trillionaire. I didn't grab it at that time. So we know that these things are out there, and that fear of missing out, a lot of these things are driven by that. Be cautious. Be cautious, especially when these things become such mainstream news that everybody is talking about something. Okay, when that happens in the investment world, that tends to be a sign of an inflection point in the movement of these assets. So is Bitcoin good or is Bitcoin bad? We don't know yet. Okay. So just understand and always be cautious about speculating in general, whether it's cryptocurrency or anything else. This is not StraightLine saying you should never speculate. There's room for it as long as it's positioned correctly. Okay. So those are the main themes that we wanted to cover today. And those are the themes that have really been coming into our office more than any others. So I do want to cover a couple of just quick things about StraightLine and some of the evolution. But before I go any further, I want to pause here and see if, number one, if there's anything that the StraightLine team or the Skyview team would like to add to any of this, or well, actually, yes, I'll do that first. Anybody from the team want to add any more detail or cover any other subject? Or did my rant that just kept going cover it all?
You did a great job.
Thank you.
Yeah,
Go ahead.
I'll make one comment to that whole speculation versus investment. To your point at the end there, just to kind of bring it home, is that speculation can become an investment if it's well thought out in terms of an overall portfolio and can bring in additional diversification, right? So it's just a good point to think about. If you're thinking about it in terms of your overall portfolio and it's a small portion of the portfolio and it's money that, to your point, you understand is greater speculation, it can add value to an overall portfolio.
Absolutely agree. And that's a good point. Two things there. One, a speculative investment can become, or let me say that better, speculation can become true investment over time. That's absolutely true. There was a time when Microsoft was, or Amazon was speculative too. Okay. Again, thousands of others that have gone away during those times for those to become as giant as they are. But there's one other word, Rob, that you said, and I'm glad you brought it up, because I meant to say this earlier in the context of the stocks that we were discussing, but also absolutely in this. And it is a word that everybody on here has heard. It's a word that I have said in these sessions and in other sessions thousands and thousands of times. And so what do you do? What is the best way to protect against all these things? What is the best way to invest through any of these cycles, but especially cycles where some things might be a little heated? And the answer is our old friend, diversification. It is simply the mantra that we have always had. It is the mantra that we expect we will always have. And as boring as it might seem, and we would use maybe tried and true rather than boring, but it is kind of boring. It's way more exciting to talk about something that's gone from 16 to 70 in the course of a year, right? Who doesn't want to see who doesn't want to throw all their money into something and have their money quadruple in a short period of time, or way more than that, right? But those things the things that can go up that quickly are also extraordinarily likely to go down just as quickly. Okay. And let me say that better. That's not the right word. Likely is too definitive a word. No, it's extraordinarily possible with speculative investments. Okay. I shouldn't say likely. That's not the right way to say that. But we've seen it, right? Here it is. Okay. We saw this happen. We saw this happen here. Even these slides that look relatively mild, when you stretch this chart out to 5 years, like I have, when these things are happening, these things hurt. Okay. And so, for all these people that, oh, I've made so, all these people have made so much money in Bitcoin. They got into it when it was 15 or 16,000. Well, guess what? People who bought it at 68 in November of 2021 are for the first time now back positive on it.
Yeah,
Right.
and Mike, can I make a comment to that? Because I think, look, you're doing something on speculative investments such as a Bitcoin or cryptocurrency has more volatility, right? And one of the things as advisors that I think having an advisor helps people with is staying invested in a market long term, right? And the potential for the impact of behavioral finance when you have greater volatility increases the chance of people making investment decisions at the wrong time. So to your point, many of those people that took that big hit in 21, 22 probably sold out and haven't made back their money back. Okay, so that's a really important point about speculation and volatility, how it increases the potential for behavioral finance and poor decisions by investors to get out of the market at the lows and buy back in at the highs, like now, to your point, because everyone's talking about it. And one last comment I'll make in terms of speculative investments in industries such as cryptocurrency, it's not just about the volatility that Mike's been talking about. You know, where regulation is not really yet developed, you have tremendous opportunity for fraudulent activity and losing your money, not just because Bitcoin went up or went down, but losing your money because of fraudulent activity as the regulatory landscape is developing. And I think that is an aspect of speculation here that people should be wary of.
Yeah. Well, very important point. Thank you. So anyway, again, with that, I think that that kind of covers the pieces that we had for today. I'm gonna stop this share again, and just open this back up for any other questions, whether you'd like to type them in, or if you have other questions that you'd like to ask, please feel free to unmute yourself and ask away. Anything else? Okay, well, I'm not seeing anything coming in either place. So again, thank you. If you have anything, again, please feel free to jump in. Thank you again for coming today. We've been talking about some other things that we're gonna add into these presentations going forward, to bring in a couple of other voices and just a couple of different viewpoints. So stay tuned. Some of you also may have seen some of the pieces that we've been producing lately. We created a new newsletter format that kind of highlights what we've been doing, some of the things that we've been saying, some of the things of us in the news, and other pieces that we've been producing on our blog. And there are a couple of other ones that you are going to see very, very soon. One of them is going to sound particularly familiar for those of you who just listened to the last piece on investing versus speculating. So we're going to put that some of that content out in a little bit different format, but we invite you to just visit the website and see some of those feeds to see a little bit more of what we're doing. And of course, if you have any questions about anything, whether it's stuff that we've talked about today in the markets, or obviously things in your own situation that you'd like to discuss in more detail, please do not hesitate to reach out. So thank you again for participating today. And Andy and Steve and Rob, thank you for joining in. So, all right. Thanks so much.
Thank you.